Hello, everybody. Kirk Spano, Retirement Income Options, December 12th, 2022. And I am back from New Orleans. It was a bit of a good trip and a bad trip all at once. New Orleans is wonderful. But on the day that I got there, I found out my grandmother, 94-year-old grandmother, whom I've talked to you about. She's the one who I was taking to Card Club for years after she stopped driving. Went on morphine on Tuesday and died on Thursday. She had been having panic attacks because the COPD, which had been killing her slowly for 30 years, got to the point where it cut off her oxygen and she'd panic. So she's been on hospice for a few months, and it got to be too much for her last week. So, you understand how those things go. Anyway, I was pretty prepared for it. That's why I didn't come back right away from the trip. Have to deal with a funeral this week. I'm writing a eulogy. Thursday is the funeral, so there will not be any webinar on Thursday. However, next week, I am going to have a full presentation on Thursday. It'll be a review of 2022 and a preview of 2023. There will be a chart book and presentation available. So if you can make it next week live, I'm sure it'll be fun. If you can't, make sure that you read the accompanying articles. There'll be a public one and member-only posts, and those will come with the chart book and presentation book, which I'm guessing is going to be 40 or 50 pages. It'll essentially be a small book. So what are we going to do this week? I wanted to teach you a little bit about reading these charts because I think that they are immensely effective for you when it comes to not only figuring out when to buy a stock, but also when to sell covered calls or sell cash secured puts. And I want to focus today on the different time frames. As we've talked about before, on TradingView, you can screen based on various different time frames. Monthly being the longest, which shows the longest term trends and the tops and bottoms of a company's market, stock market, based on the long-term time frames. So when you take a look at a screen and you put in the time interval of monthly, it's basically showing you very long-term trends. I'm going to start with Google because it has a long chart. So this is Google going back to 2014. On the monthly chart, you can see how the various indicators look. Let's stretch out the relative strength index. Now, I'm not using exactly the indicator everybody else uses. I have mine based on timeframes that I think make sense, and I'll lay those out for you in an updated technical article in the Getting Started section. But what you can see is that when Google first came out, nobody believed. That changed relatively quickly to the point where the stock became overbought. This region above 70 is traditionally overbought. It can go all the way up into the 90s. Doesn't always happen, but somewhere in the 70s and 80s, this is indicative of overbought. And usually when the monthly overbought signal occurs, relative strength index above 70, that usually means that there's going to be a correction of some substance. So if we take a look at this first one, company IPO was a Dutch auction, I believe, came overbought by the end of 2015. So let's take a look at what happened in 2016. Stock ran up through the end of 2015, and then it became a choppy period. So there was basically a shortage of buyers. So during those 4, 5, 6 months, what we saw is that it became less overbought. And we essentially got a 6 to 9 month period where the stock didn't go up. Now the stock starts to become overbought again. So what happens during 2017? What we see is that there's a substantial rally in the stock. If you follow along relative strength index with the price, this is usually indicative of a type of market movement. Now, there will be divergences between price and relative strength index. And usually that means that one or the other is going to change directions. So when the relative strength index is high and it starts to fall, that almost every single time means that the stock price is about to fall. So you want to look for those divergences. Right now, the stock price is falling, has been for a while, and the relative strength index has been coming down. what we would be looking for here is for the relative strength index to go back up. How can you do that? Well, the easiest thing to do is change your time frame. So if you go over here, move to a shorter duration time frame. So we were looking at the 1 month chart, switch to the weekly. We know that the monthly has been falling, so we'd be looking for a shorter duration chart to start to rise, which would mean that the longer chart would follow, but the price would also follow. So let's take a look at the weekly relative strength index after having looked at the monthly. And you can see after falling, it started to jitterbug around. Now, can it come down a little further before it goes back up? Maybe. Let's look at a shorter term time frame. Well, look, the daily looks like it's about to become a little worse, but that should mark a bottom. Why would I say that? Look at how it's triple bottomed here, once, twice. And the first bottom appears to be the lowest, and the second bottom was a little bit better. What do we want when we look at things? We want to see a rising trend somehow. So it looks like the bottom here to the bottom here indicates that there's less selling. So some of the people who bought down here were not inclined to sell down here. They're holders. And as the holders increase, the share float decreases because they're in strong hands. And that means any buying pressure can be met with significant price appreciation. So do I expect this to become oversold all the way down here again? Probably not. I think it'll be closer to this area. Now, if it goes lower yet, that just means that your second scaling in position in Google, or third, but your next scaling in from when you buy it in here to if you have to buy it down here, which just means that you get lower prices. But over the very long term, again, you're not trying to pick bottoms. You're trying to scale in at low price levels based on the fundamentals and the technicals. What would drive Google to become even more oversold? Something really bad happens, right? Either with the company or with the economy in general. Those sorts of things are incredibly difficult to predict, especially with any precision, which is why 4 out of 5 traders lose. Essentially, what we're trying to do is understand how a security or a market is trading, knowing that 4 out of 5 people are bad at it, and we're taking advantage of them. I'll give you an example. And this doesn't just apply in the stock market. It applies in relationships. It applies in poker. It applies in your careers. Is when people make emotional decisions that are relatively uninformed, bad things will happen to them in most cases, unless they get lucky. And good things will happen to the people who have a more informed and less emotional approach. Spock versus Captain Kirk. Now, let's think about that statement. In Star Trek, Captain Kirk got out of some pretty hairy situations, and that's because the writers made him a hero. But if you think about some of the emotional, angry things that he did, do you really think he would have survived as long as he did? Makes you think that Spock really saved his ass quite a few times. And in the stock market, you want to be more like Spock than you do Captain Kirk. Yet, most traders are more like Captain Kirk. Pew, 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 shooting all the time. You should pick your shots a lot more carefully. Always start with risk management and understanding of what these charts tell you in multiple time frames. And on top of that, you want the fundamentals on your side. So I've been saying for the better part of a year, except for a couple of months when it was time to buy a correction, you wanted to be high in cash. More often than not, you wanted to be looking to sell something than buy something, especially if you were, broadly diversified across the S&P 500. Most of us aren't at this point, but there's newer people who still have S&P 500 funds. I'm just going to write an article, I think, to make my position very clear. You should never own an S&P 500 fund. What is the point? You own all the bad things with the good things. If you have above average intelligence and you're willing to do a little bit of work, at least a little bit more than the next guy, you should be able to be above average. If you're subscribing to an investment letter, you need to believe that you can be better than average. And just by being better than average, you should beat the market by several points a year on average. Our simple approach to selling options almost guarantees that, especially when we get the next bull market. And all the stocks that we've scaled into at prices that seem nonsensically low, and a few of them deserve to be low. We just don't know it yet. But most of them are going to go up in price significantly. I'm not talking 20 or 30 or 40%. I'm talking triple, quadruple, quintuple, whatever, a lot. We'll take a look at a Metis real quick, because that stock people have been asking about because it's been getting hammered. So here's the daily chart, the relative strength index, extremely oversold. What does the price look like? Stock prices come down. So let's work this in reverse. Take a look at that relative strength index. It's been getting hammered lately. So let's take a look at the weekly. How does the weekly look, right? It's near the bottom for the last couple of years. Take a look at the monthly. Almost as low as it's ever been. It seems to hold this area here. Why would that be? Because there's some pretty strong hands buying this stock. GMO, BlackRock, got some big guys buying shares in this company. The float has been shrinking while the stock is heavily shorted by traders, which is indicated here in this daily chart, heavily shorted since about August. So it went from rising stock price. We take a look at August, right? Rising stock price. They started to short it. It's just been coming down. Relative strength index looks almost the same. So what we're looking for here is on a daily, we're looking for a divergence. Maybe we have it right there. Maybe it comes down again. But on the daily, we want the daily to start going up because it'll drag the weekly up, which will drag the monthly up. So we work these time frames forwards and in reverse, and we look for price divergences that make sense based on our valuation model. We know that there's been institutional accumulation under 10 twice. We know that the CEO doesn't want to dilute the shares because he's a large shareholder. But we know that the traders have some power right now because they still have access to margin, and the Federal Reserve is draining liquidity from the markets. This chart here, which is similar to a lot of small cap charts, hits small caps first, which is typical. What I said on fundamental trends this morning, somebody was asking about Ametis. He was asking, are we bag holders on Ametis? So here's my reply, is if you truly understood the company, and somebody on that website basically ran through a couple things for him, then you'd understand that Ametis under $10 a share is a gift. Under $5 a share, it is a gift born by ignorance and emotions and aggressive trading by the shorts. So when you see a chart like this and your response is to be scared and to worry, am I a bag holder? That is a product of you didn't do your homework. That's what it is. Traders can push stocks all over the place. They can push things up a lot. They can push things down a lot. They can especially do it in stocks that are at the early phase of their initial buildouts where capex is high and earnings look low. And they can do it especially in small caps where the float is easily shorted. So when you see charts like this and you panic, I think that that is an indicator that you ought to go do some reading. I really do. I think that that's been proven over and over again. One of the things that I do for you is I create bottom fishing price ranges. And last year in November and December, we had a lot of stocks on our very short list where I said they'd come down 30, 50, 70% in price before I looked to buy them. And people told me I was crazy. Now, this is one stock where I was saying, buy it in here, right? We talked about Ametis right around $5 a share the first time. And then when it came back down here and in here, we were buying it again. So what's the blowback that we get? But it's lower today. Yeah, man, it's 8 months, 9 months later. Big deal. 8 or 9 months. Who cares? Markets go through cycles. Stocks go through cycles. A lot of it has to do with the Federal Reserve and liquidity. A lot of it has to do with CapEx. For small companies, it has to do with building the business. For large companies, which people falsely believe are safer than small companies, I'm not talking about micro caps, but small companies like startups. Startups are dangerous. They fail all the time. But once a company's on the stock market, the difference in risk between a small cap and a large cap, right, of a listed security, pretty negligible. People don't want to believe that, but every statistic out there says so. But the small caps are more volatile. And people equate volatility and risk, which isn't necessarily true. It just means that the public perceptions and emotions and the ability to move prices based on liquidity are what they are at a given time. So if you go across all the stocks that are beaten up, and we'll go back to our screen here in a second, you should ask yourself a question. Is this company more likely to be worth this much or more likely to be worth this much? And you'll know that not from the chart, but from knowing what the company does, what their chances at success are. And with this company, things that I've been talking about since 2017 and really doubled down on in 2020 are all coming true. What I've been telling you that is going to happen in energy. I've told you that we're largely going to go to solar and microgrids using batteries, especially at the commercial level, and that we were going to move towards carbon capture and biofuels that captured carbon from agricultural waste. I've been telling you that for quite a while. And that's how I found this company, because I talked about that. And one of the subscribers said, hey, have you heard of these guys? I know the CFO. Check it out. Tell me what you think. That's exactly how that conversation went, because that's how all of our conversations go. Take a look at this one. That's all I'll tell you. So I looked, did the research. I liked it. A couple other companies that he's talked about with me include Micron and some others. One of the things I did in New Orleans this week, and I didn't have connections or time to do much more, but I did meet with a couple of oil guys, some guys that I thought might be willing to come to New Orleans because they're in Houston normally. And they said, sure. So a couple of guys I know from Houston, they're energy traders, came over to New Orleans for a couple of days and we met for lunch. Those types of conversations are gold. And think about this. These guys were willing to take a couple of days and just hop on over to New Orleans. Hey, yeah, let's talk. Let's have lunch. We'll fly to New Orleans to have lunch with you, right? So I do a lot of consulting for free to get the information that those guys give me. And what they're telling me is that carbon capture, which is really being driven by Chevron, and then Occidental, and then Exxon, and ultimately the federal government, is going to be huge. Ametis is going to be the biggest or second biggest in California, depending on what Chevron does. Probably be second biggest. My guess, even though there's a bunch of Chevron guys, ex-Chevron guys on the Ametis board, I think that Exxon actually is the more likely company to buy Ametis. The reason being is that Chevron's already pretty big in California. So from a Justice Department outlook, I'd say Exxon's more likely to buy Ametis. Because if you've looked at the Exxon advertising lately, they're talking about carbon capture, but they're way behind, right? They're talking about it to make people think they're doing it, but they really are pretty far behind Chevron and Occidental. Chevron especially. Chevron's clearly the leader. So you ask yourself a question. If I liked this company at 400 or 500 million in market cap, how much more do I like it now at 200 million in market cap? And how am I treating it in my portfolio? If I don't own it already, you must take a starting position if you ever invest in growth stocks. It's just that cheap. Comparative companies to Ametis have already gotten bought out for $3 to $5 billion, which is what I thought Ametis would get bought out for until lately. A year ago, we talked to the CEO, and he said that they were going to be able to put $5 billion of contracts on the books for the next 5 to 6 years. And they had a 5-year plan. They're at $7 billion. Crushed it. Take a look at all the major airlines that are buying their, or will be buying their jet fuel in San Francisco. And remember a year ago, I said, I don't think it'll take much for them to get into Los Angeles. And they did that too. So when we talked to the CEO a year ago, it was $5 billion in the San Francisco airport and a few airlines. I believe they're up to 11 airlines in San Francisco and LA, $7 billion. And remember, they cut a deal with one of the big truck stop companies to sell natural gas, renewable natural gas. What has just been in the news in Washington, D.C.? They want to push renewable natural gas, and they've come right out and said they want to see agricultural feedstocks, not out of the food supply chain, but from the waste, because that means that they don't have to burn all the wood or all the crops that are dead, and they don't have to have big sludge piles of manure. So between carbon capture and fertilizer, billions and billions of units of whatever they're measured in, trillions probably, or zillions, I don't know. All that carbon release, released back into the atmosphere, they're going to capture it and use it as fuel, making it a circular thing. And Ametis was on the front end of that and captured the California market, which is the 6th biggest in the world. And by the way, they have a paid-for refinery in India that's starting to produce revenue and profits. But the company's in debt. Well, I'll tell you what, they have a paid-for asset in India that India needs. If they really need to sell it, they'll sell it. They'd rather not. So know the stories that you're investing in, know the companies. I know that that's hard to do, but you know that I don't regurgitate a lot of what's easy to find. So the baseline research that you always need to do is to go to the website of a company that you're invested in or thinking of investing in, right? You should do it beforehand. And read their company presentations and at least skim the prose of their quarterly reports and annual report. Go back about 2 or 3 years so that you can see if they're progressing. And you don't have to understand everything. You need to get the 30,000 foot view from those free, public, regulated statements that they put out. And I understand that you're not going to understand all the accounting or jargon. I'll explain the important stuff and why I think that this is a good stock to invest in. So Metis at $24 a share was what, 700 or 800 million in market cap. I didn't buy it in the 20s, but if I did, it wouldn't have broken my heart. The reason I didn't buy in the 20s is because I knew from relative strength index that, probably going to have a correction. But now from relative strength index, we know that it's probably close to a bottom. So you want your starter position at least. Metis is my biggest stock holding. And you can also sell cash secured puts. So if you buy a Metis at 4 and change, then sell a $5 or $4 put so that you get a price in the threes, you've effectively scaled in at two different price points that are pretty far apart, right? We always want price points that are 20 or 30% apart. The bigger gap, the better, because that affects your cost basis better. Or the stock goes up and you have a starter with a low cost basis and some income. Either way, it's win-win or win-win. You can't lose, right? Unless the stock never goes up again. All right, so let's take a look at the screen again. Take a look at some other things. I just want to conceptually go through some of these and we'll fire through a couple of the charts. Coinbase, is it going to be around in 5 years? That's the only question to ask. I'm not sure why these are all on. Must have been doing some comparisons. So the question to ask with Coinbase is, will it be around in 5 years? Set up the new chart. So I'm getting rid of the orange boxes just because they're hard to use. And I want you to be able to see roughly where I'm getting these prices from. So the buy zone is in here. It's based on the volume profile, Wyckoff and other stuff, but it's easy for you to see the volume profile. This is where the big action came in, the buying and the selling. Those big whooshes of activity usually indicate this is a range that's likely to hold. Now, if all of a sudden this breaks down lower, we get a big bar here, we go, oops, we have to move our bar. I don't think that's likely in this case. We switch this to the daily, what we see, that's a heck of a base, isn't it? What do we like to see with stocks that are beat up? Is that they hold a range, it gets narrower, they don't break down again. If we go over to the Elliott wave indicator, we can see that it's not sold off like this again. It's been kind of bouncing around. And this trend here is positive on the daily. Is it that good on the weekly? Indeed it is. Not quite on the monthly yet. Oh, because there isn't a monthly chart. It's too new. But that's the right direction, isn't it? So if there's another leg down in Coinbase, so be it. But if you think the Coinbase will be around in 5 years, I'd say start taking a position. Now, I've taken my position through an ETF. I own DAP, which I'm handsomely down on, but its biggest holdings are Square and Coinbase, which I like both companies. If you're a trader or you just want more beta in your portfolio, right, more volatility, you don't mind, then I think you should probably be taking a starter position in Coinbase here, or at least selling the cash secured put. And I'll put the put into the article for retirement income options tonight. I'm still a little bit behind because of the trip. So let's go to DNA. Another newer stock. People are ignoring it. They have biases, things that they don't understand. And that's usually the case. When people don't understand things or they look different, like immigrants, they get scared. They don't look like me. They don't look like what's in my portfolio. Xenophobia is everywhere. Get over it, and you'll be a better investor. $1.90 for Ginkgo Bioworks. It's down 85% from its peak. Will it be in business in 5 years? That's the only thing you have to ask. I think the answer is yes. I think the fact that they have dozens of partnerships and streams of revenue now that are just slowly starting to, stack up, I think it's a pretty easy story. So if you go to their website and just do the basic reading for a few hours, what you're going to find is that their streams of revenue are going to stack up. And by the way, what did you see in biotech land today that I told you, a couple of months ago was going to happen? Big M&A deals. Amgen just bought somebody for $27 billion. Had to take a loan out. If you own Amgen right now, you should be selling it because they're going to have to figure out a way to pay some bills. And then when everybody hates them, right, let's pull up Amgen. Let's just start over. Right. Does this look like a chart you want to be involved with? I mean, if you bought down here, right? Up, Amgen. I mean, that's a spectacular chart, isn't it? But the monthly RSI has started to break down. But wait, the stock's going up. RSI is coming down. What did I call that earlier? I used a word. What word did I use? A divergence, right? Divergent is a movie. It's not a bad movie, but divergence. Divergent might be a type of person. So you take a look at this. I almost wish I could put in a something where you could say stop. So let's play this like a Price is Right game. What's the music for pick a price? I'll probably use Jeopardy music because it's the only one I know. Do, 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 do. Where's bottom fishing? How many of you think bottom fishing is right around here, right around 200? How many of you think bottom fishing is right around 160? Nobody? I'm going to say that the top of the buy zone starts right around there. And where's bottom fishing? Well, I think there's some legitimacy right here. So let's shorten up the chart because that stuff in the 90s doesn't matter. Let's go back to 2014. Let's make our chart the appropriate length. Go to 2014. Okay, there we go. That's easier to look at. Time frames matter. There you go. Hit that one right on the head. Look, why did I put the buy zone starting right about there? I couldn't see that on the other chart, right? I couldn't see that before. I was just looking at where the jitterbugs were. Right about here, right about 190, something under 200, right? Because the buying and selling pressure changed. You got to fill that gap. Oh, where does this one go? That's the hard one. Could it come way down here? If it gets to there, it might get all the way to here. I'm not saying that you can see a price of 115 on Amgen, but I do think that's about as bad as it would get. And if you can get a price on 115, visualize this in your head right now. If this chart goes down for 2 years or 3 years, and all of a sudden Amgen is way down here, what are most people going to say? What are 4 out of 5 people going to say? They're going to say Amgen sucks. I would never buy Amgen. Shoeshine boy, Amgen sucks. Uber driver, Amgen sucks, right? There's nothing wrong with the company. I'm probably buying the heck out of this stock down in this price range. I might take a nibble here if I'm a dividend investor and I believe in the dividend, because Amgen pays a pretty good dividend. And if the old men don't get scared out of this, at $190 a share, the effective dividend yield would be a little bit over 4%, plus whatever they increase it by. So right in here, 190-ish, 200-ish, dividend gets up to around 4%. If we're in a bull market, you can probably buy that. If we're still in a bear market, you probably wait for an elevator drop way down here. What does relative strength index say? Still pretty high, and it's been weakening. What does the weekly look like? Had a little bit of short-term rally, it came off. What's daily look like? Fell off a cliff just now. Why? Because the smart money knows $27 billion in loans to buy another company is going to take some time to digest. So Amgen could very easily fall way down here. Not saying it will, I'm just saying that it could. The right place to buy might be 190-ish. But 115, when everybody says it's the worst stock on earth, psychologically and emotionally it might be hard to buy, but it's probably, as Spock would say, logical investment at that point. As we go through these, the same story plays out over and over again. Intel, Warner Brothers Discovery, Generac, Amazon, Open Door, which just changed their CEO. What was I saying the last several months about Open Door? The CEO either had to change his strategy or be kicked out. They kicked him out. Open Door has a very viable business model and the right partnerships. And higher interest rates are better for them because as interest rates come back down a year or two out, it's just all money that falls to the bottom line. So if they do what I said they should do, which is what? What did I say they should do? Remember, I'm a pretty good business consultant. I mean, people pay me for that stuff. That's right. Rent out the properties. Don't sell them at a loss. If you got a $400,000 house to sell, Open Door, you can find a pretty good renter. I mean, these are not slum houses where people who don't care. That was a broad, sweeping generalization statement. I'm trying to catch myself saying things that could be controversial. You know, like telling people to fuck off. That's never a good thing. It's funny, not always a good thing. In any case, these guys got to my bottom fishing. They're there right now. I think, again, if you are willing to have small cap stocks in your portfolio, really right there, you should be buying Open Door right now. It's a little bit of a gamble because we don't know about the management and the execution, but I really like that they told the CEO to do something else. He's working on a more technical job. They brought the CFO in to make the final decisions. All right, CFO, make us money. That's what they did. Okay, CEO, technical guy, just work on the technology and the marketing and the relationships. I think it was a good realignment. Now, am I telling you to put 6% of your money in here? No. It's a 0.5%, 1% position. 2 if you're dollar cost averaging lower. Selling a put on this, I think if you already own it, pretty neat. Let's see, what can we sell? We can sell the January puts, $2 puts for 65 cents. Currently trading at 139. Man, there's no point in even selling the put. This stock is so cheap. If you're willing to own it, you believe they can turn it around based on the fact that they've recognized they need to turn it around, right? First step is admitting you have a problem. Bringing in the CFO, which I think is a quality move, then you should just buy Open Door right now. Put it in the drawer and see if they're around in 5 years. If they are, they're going to be worth a lot more. All right, go back here. You got Square. This is probably a case where the RSI is flattening out and ready to turn around. Sure enough, let's take a look on the shorter time frame, the weekly. Look at that, it's starting to come up. Stock price coming up yet? Not quite. So here's another divergence. Disney, right? It's in the buy zone. I must have the percentage set because I was comparing things. I like the entire streaming space. By the way, is there a Disney in China? That's a pretty interesting question right now, isn't it? I think if you've wanted Disney, you could probably buy it in here or sell puts. It doesn't mean it's not going to get down to these post-financial crisis prices. But boy, oh boy, I have a hard time seeing that. I could see that though. If it does actually get into the 70s, Kirky will be a buyer outright. Paramount, another one that I really like. Again, we can go all the way back to the financial crisis if we want. Let's see if this holds. Don't know that it will, but it could. This is based on weeklies. So let's take a look at the RSI, still falling on the monthly, with the weekly starting to go up. So let's see, maybe there's one more dip and then it rises again. This seems to be putting together one of those bases that we talk about. And then here's my trend line. So we need to hold this trend line. Can't really go below 16. If it does, I don't know what's going on if it does. So again, sell puts if you already own it. If you don't already own it, buy it. Unity, look at that. That's nice base developing. What does the RSI say? We're going to need a weekly RSI because the short chart generally need 5 or 6 years for a monthly RSI to matter. But look, trending up, but the price hasn't really recovered yet. So another diverge. Comcast. I actually got to talk to somebody about Comcast on accident. Another one of those, somebody from California I bumped into playing poker. Oh, I didn't tell him my poker story. I'll use that to make the point at the end. So right there, I'll get rid of that. I talked to somebody who is an actual Hollywood person, an agent. This guy was loaded. What he said was that the talent in Hollywood starting to realize that the super high speculative paychecks from the start of the streaming wars are gone. And they're looking at more creative ways to make money from the bottom to the top. And the deals that you're going to start to see are movie stars, the big ones, saying, I'll take less money for more participation in the upside. Yeah, it's probably only several dozen people, right? But they're essentially going to find a way to get equity in these companies or something, some share of revenue, something. We'll see how management and the stars work it out. But I think that's pretty indicative of a bottoming process in the whole sector. We know that there's a shortage of studios. We've looked that up. We've seen the proof. And now all we have to do is wait for this final consolidation to finish out. So this entire basket, Paramount and Comcast, Disney and Netflix, Amazon, who have I missed? Warner Brothers Discovery. I think you just got to own them. And I wish there was a great ETF. And if somebody finds one, let me know. But I'm A-okay owning half a dozen of these stocks. Haven't added Disney yet. One more leg down, I would. Next thing I'm probably going to buy is Amazon. I already own Paramount, Warner, a little bit of Comcast. And when I look at my TV screen on my Roku, and you can do this, with any smart TV, you take a look at the streaming services you have. I mean, unless you're really big into Yellowstone, couple other shows. Peacock is the last one I added because I got it for a year for $12. Think that through. A year for $12. They're giving it away. Why? There's got to be a deal coming. There's got to be. And whether it involves them or not, there has to be more consolidation, mergers, something. So we're seeing that in the streaming space. It's already happening, but those stocks are already beat to heck. And we're also seeing consolidation takeovers, basically big pharma, big biotech taking over the smaller companies. To ask yourself the questions. What does that mean? In biotech, it means that the growth is coming from the small companies. Focus. So we want to own small cap biotech. And I'm just going to buy a basket because I'm not smart enough to pick out the companies. I've done it a couple times and it's just so time consuming. I am trying to interview a big time biotech analyst, just to give you a perspective. But I think you buy the ETF that I pointed out and sell puts on it. And for the streamers who are already beat up, I mean, there'd be a little bit more pain, but they're just values. So always remember, it's not just the technicals, it's ultimately value. Sometimes oversold gets more oversold, but if you're already cheap, cheap is cheap. And you just start scaling in. We get as close as we can, but you don't want to not have a position when something, when there's a news article and all of a sudden it's up 25% or 30%. So, all right, I'm going to let you go. I'm going to go see the grandkids for a minute. Then I have to run and pick up my car, which has been in the shop for a week. It ended up just needing an oil change and a serpentine belt. So no big deal, but I figured while I was gone, I'd take it in. Again, no webinar on Thursday. I'll be at Grandma's funeral. And then next week, big presentation. All right, take care.